Battleground Investor here, reviewing the CPI that was released this morning. I've seen the trading day being running a little bit without much change, even though the CPI did print hotter than expected. Wall Street had a 5% year on year and a 4.9% month on month. And we're going to go over exactly the report to share with you guys. And I've opened up a lot of these already, but we'll just go over the newsprint for now. And we can see the index for all items, less food and energy, rose 0.9%. Excuse me, it was a 0.5% month on month that was expected, but we rose at 0.9% for the month of June relative to the previous month of 0.7% in May when you strip out food and energy. And they've listed here very clearly many of these items that were running hotter in May were still running hot in June, and that's the cars and trucks, new vehicles, airlines, and apparel. And we can look at it here on the seasonally adjusted 0.9 this month compared to 0.6 month. This is all items. Obviously, I've listed all items less than food and energy, which was up there. And with that, you can see it's 0.9 compared to 0.7 on the previous month. What we're really looking for is for this to trend downwards. It was starting 0.8 to 0.6, but it actually bumped up to a new high. I think I haven't seen that since this entire recession and rebound that we've been since COVID. So this is clearly we're having month-on-month inflation. And if you were to annualize that, that's nearly 12% annual. That's like 10.8% inflation. That is very high. I was expecting the market to shift much more. It didn't really. We'll get to the sticks in a bit. And this is what's being printing on headline news: 5.4% annual unadjusted 12-month change. But these month on month are the ones we're looking at and the ones we care the most about. And how's it go? When you look at it, really, the biggest changes were still the same things. But just a brief technical note on CPI to understand it. We're looking at the index that measures from 1982 to 1984. That's 100 points. And then as things change, that's the base figure. Say in December 1999, that's for the CPI-U. So you have two different parts to the CPI, the U and the W. And this signifies the chained CPI versus the unchained CPI. But, excuse me, the main ways of calculating it is as I share here. There's been a 9-point change from 21 to 12. And that 9-point change divided by the base figure of 112.5 times 100 for percentage gives you an 8% change. And the same thing for item B, they'll do that. And item C. And then they weight it. And based on the weighting, you'll get a total percentage change for your CPI. That's probably the most important thing here to look at. Here at table 1, we'll go just directly like this. We can see that some of the biggest changes, again, month on month, a 0.9 change compared to the 0.6 change. It's not the end of the world. I'm expecting probably this to really start trending back down to normal month on month and year-on-year figures by around September, October. I'm only maybe 70-80% confident of that, but I do still expect it to trend back down to a normal level, in line with the Federal Reserve's. The biggest impacts that was introduced already on the report, but we can look at it into the table to see like what the changes are that maybe they didn't list. I can already see 0.9 and 0.7, not the biggest, but that's still a movement up. Fruits and vegetables, non-alcoholic beverages, and food away from home slightly bumped up, but the bigger bump, maybe 2.5 here at meats and poultry. So we see our food at home kind of, this has gone up. Interestingly, energy a little bit up. So we're seeing a broad spectrum going up. All items, less food and energy. Okay, sure, we've covered that. Here, a little bit more commodities. It's gone up. Okay, apparel has gone down. Not as bad as the previous month. Still worse than the other month before that. Biggest one obviously is 10.5. Used car and trucks. That's 10.5% increase in pricing, and then you had 7.3 and 10.8. You have a lot. If you are buying or selling a car right now, secondhand car or truck or vehicle, let me know in the comments. What are you paying for? What are you getting? What is it be? What are people paying for your car or vehicle? I'm interested to know. I mean, it looks like they're pretty expensive now. This is month on month for several months. So that's the biggest part, clearly. And it has been. So we need to fix this. Come on, Ford. Let's go. We see a broad range of increasing slightly. No, not really. Not here. No, this is not that. This is pretty much similar. This is a drop. So airline fares. Okay, people are taking less trips. It is still an increase, but it's not as bad. That is a clear trend back down. 10, 7, 2.7. Okay, that's not that bad. We don't need to go to the chained one, really. I mean, 5.4 versus 5, we already know the headline figure. I mean, this headline figure is not that critical. For the unadjusted here, we can see that. Okay, if it's 5.3 versus 5, depending on which CPI you're using. But there you go. How's this affecting us? Let's look at the sticks. So when we opened up, where's the minute? There we go. When we opened up today, in pre-market, I think it was released at 8:30, so 7:30 my time. You're seeing it in Central Time. The S&P 500 just started falling, bottomed out about here, and rose. So that's really only a few points, not much. Really not much. Now things are just back to where it was. So yeah, it indicates to me 10-year didn't really get affected too much. It bumped up in yield briefly. Just a few basis points. And then it's back down. So really the market said, who cares? It's priced it in, even though this was on the higher end for me. Again, I don't expect permanent inflation. This may be the market expecting some form of the inflation not being transitory, and so this was expected. I still think it's too early to tell. I think September, October is a good time by then to see the trend, where it's going. And I think maybe a lot of think it's permanent also, or thinking that's transitory, are also thinking, hey, we have time to really find out if this is going to remain elevated and continue elevating, while people who already believe it's permanent or somewhere in between are going to expect it to remain elevated for a little bit of period of time to a long period of time, depending on if they think they're in the permanent camp. So everybody's kind of priced it in, it looks like. What else are we seeing here? Right. We see the difference here. The 10-year minus the 5-year Treasury bill rate at 7:30 when this was released. We see the spread falling, so that the 10-year is actually the difference between is less. That would indicate a flattening of the curve. This is that's an interesting outcome, and it's kind of trended down. It stayed down. That's an interesting outcome. With inflation, you would have thought maybe a bit more growth. It might be that, hey, the bond market is saying, and the different parts of the yield curve, that basically this inflation is holding back growth in a real economy, because more things are going into prices rather than supplies outputted and getting into the hands of customers. That's definitely a possibility, and yeah, we can see back here in June that was a major flattening of the curve occurring here. This curve is not flattening, but if we were to plot the yield curve, you want a yield curve to be going from left to up, and that would indicate that the later dated yield curves on the right hand side, like a 10-year and the 30-year, would be higher interest rates as or high yields to reward people for taking the risk of holding a longer durated maturity. But because this here is identifying the difference between the other curve, which I don't have here, you construct that yourself. If anybody knows how to pull it up on the Thinkorswim, I'd love to know if that is a curve possible. But this is all I found, where you take the difference between the 10-year and the 5-year. But basically, the fact this is going up would indicate that the spread, this total amount, is larger, and therefore the beginning here figure on the other curve is actually lower than the later part of the curve. So that it would indicate the steeper curve. So the higher you go here is a steeper yield curve. The lower you go is a flattening, more shallower yield curve. And for that reason, this is kind of interesting, because inflation is now being considered not growth, not pro-growth, but is holding growth back. So if you find this helpful, let me know if you want me to talk more about the yield curve. I can probably pull up the curve itself. Let me see. But basically, if you want a video on yield curve, let me know, and I could probably do a video on that. And if you find this helpful, just give me a like, subscribe. It helps me bring more of this. And just let me know what you guys want to see in the next video. It could be about the yield curve. And I hope this is helpful for you guys.